Okay, welcome to Sharpen Your Edge. This is session 12. I'm glad you guys are here. Hope you had a good lunch. And what we're going to be studying, we're starting a brand new study on Anna Colling's A Complete Guide to Volume Price Analysis. Read the book, then read the market. This is one of my favorite books, one of my favorite studies, and I'm glad that we could finally explore it and bring it in to you. I think that the information here is really valuable for our type of trading. And once you understand this, this will help you read the beginning of trends and breakouts easier. So we're actually going to start with chapter 2, why volume. But before we do that, let's talk a little bit about what volume price analysis actually is. I love this quote. All financial markets are manipulated in one way or another, and the only way to know whether a price move was genuine or false was by using volume. Volume cannot be hidden. It is there for everyone to see. So true. It is one of the true, most accurate indicators that we have. So what is volume price analysis anyway? So just as a primer, volume price analysis is a trading methodology that focuses on analyzing the relationship between volume, price, and price action in financial markets. Volume price analysis is really only about two things, and that is whether volume and price agree or if they don't agree. And is there confirmation of this, or is it just an anomaly? And also, volume price analysis offers traders a powerful tool to decipher the market's language and make more informed trading decisions. Now, understanding the dynamics of the market goes beyond mere price movements. It involves decoding the language of volume. All right. Jesse Livermore wrote this over 100 years ago, and it's as true today as it was then. There is nothing new in Wall Street. There can't be, because speculation is as old as the hills. Whatever happens in the stock market today has happened before and will happen again, and has been happening every day. Jesse Livermore was one of the big early huge traders who figured out volume and price when all they had was volume and price movement. Back then, 100 years ago, these were their indicators that they used. They used ticker tape, and this is an example of ticker tape. I'll show you something a little more closely. But you can believe just reading a machine and being able to tell when a trend or a breakout was happening just by looking at volume and at price. So here's just a close-up of a piece of ticker tape. The first one, 100 shares at 45.17. Volume is not displayed. It wasn't always displayed. The second price of ABC, 9,900 shares at 45.25. Mixture of volume, zero remove. Note the use of the S for shares. And then finally, 10,000 at 45.30. Above this figure, volume quoted in full. So this just shows you what they were looking at really from minute to minute on how they would tell if volume and price were beginning to show us a trend. So notice that volume is increasing and price is increasing at the same time. So, chapter 2, why volume? Well, it's not an unreasonable question to ask, and it's actually a very important one. Now, in this chapter 2, Anna explains why volume is the only leading indicator, which when combined with price can truly reveal the future direction of the market. And additionally, volume reveals something equally important, whether the price action is valid or false. Volume and price are potentially the only true leading indicators of future market activity, right? The volume indicator is a vital tool that we use as traders to understand the liquidity and market activity when trading what we trade. Volume measures the number of shares or contracts traded during a specific period, providing insight really into the buying and selling pressure in the market at any given time. Now, many traders, including us, we rely on lagging indicators. For instance, rely on the MACD and on our zone system. Now, these lag behind the market and are not really predictive of market action. And price on its own is just that, it's just price. And volume on its own is just that, it's volume. So combine price and volume together, and they become a really powerful indicator of future market activity and may actually predict a market move before it happens, much like our zones do. Now, this is one of the reasons why we utilize volume weighted average price, or VWAP, and why it's so important with our trading methodology at Tim the Trader. Volume is not perfect. Nothing in trading is. May be reported differently on different trading platforms. Is relative. We are watching an average, above average, or below average day or time frame. Without price, it's meaningless. Volume on its own only indicates interest, and your volume or time frame are a key component of why we track volume levels on our charts, wishing to see a volume near 100,000 trades per minute to indicate strength and trends. Now, I want everyone to sit back now. I'm going to tell you a story. I'm going to tell you a story of how market making came to be and by this illustration. So sit back. I'm going to read this story. One day, after a particularly bad day trading, my Uncle Joe took me aside and consoled me with some hard facts about how the market really works. And he told me this story. You see, my Uncle Joe owns a unique company, which has given him an insider's perspective on how stock price movement is managed. He has a company. His company is Widgets Co., and it's the only company in the state that distributes widgets, and it does so under a license from the government. Now, it's been buying and selling its unique widgets for many years. These widgets have an intrinsic value. They never break, and the number in circulation at any given time is pretty much the same. Now, being a reasonably clever man with many years of experience managing his business, my uncle soon realized that just buying and selling his widgets to customers was, in fact, kind of dull. The amount of money he made each time he bought and sold was really small, and the number of transactions per day was also low. In addition, he also had all the running expenses of his office, his warehouse, and his staff. Something would have to be done. Having given the problem some thought, he wondered what would happen if he mentioned to a neighbor that widgets could soon be in short supply. He knew his neighbor was a terrible gossip, so this was almost as effective as putting an advertisement in the local paper. He also knew from checking his warehouse that he had enough stock to meet any increased demand should his plan be successful. The following day, he met his neighbor outside and casually mentioned his concerns, begging the man to keep it to himself. His neighbor assured him that he wouldn't breathe a word. His lips were sealed. Several days passed and widget sales remained flat. However, after a week or so, sales started to pick up with more customers coming to the warehouse and buying in larger quantities. It seemed his plan was starting to work and everyone was happy. His customers were happy and they knew that widgets would soon be in short supply, and so their value would increase. Uncle Joe was happy because he was selling more widgets and making more money every day. Then he started to think, with everyone buying widgets, what would happen if he raised the prices? After all, he was the only supplier and demand was high at the moment. The following day, he announced price increases, but still believing there would soon be a widget shortage, his customers continued to buy in larger quantities. You see where I'm going with this? As the weeks passed, he gradually increased his prices higher and higher, but still the buying continued. A few of his more astute customers started to sell their widgets back to him, taking their profit, but Uncle Joe didn't mind as he still had plenty of willing buyers. This was all good news for Uncle Joe until one day he suddenly realized with some alarm that his warehouse was now looking very empty indeed. He also started to notice that the volume of sales each day was decreasing. He decided to keep moving prices up so everyone would think that the situation was unchanged. But now he had a new problem. His original plan had been so successful. How on earth was he going to persuade all his customers to sell widgets back to him so that he could continue in business? He pondered this problem for several days with no clear solution. Then, quite by chance, he met his neighbor again in town. The man drew him to one side and inquired whether the rumor he had heard was true. Inquiring into what that rumor might be, Uncle Joe learned that his neighbor had heard that another much bigger widget distribution company was setting up business in the area. Now, being clever, Uncle Joe realized that Providence had given him the answer on a plate. Appearing crestfallen, he admitted the rumors were true and that his business would suffer badly. More importantly, widget values were likely to drop dramatically in price. As they parted company, Uncle Joe chuckled to himself at having such good fortune and such a helpful gossip as a neighbor. Within days, he had queues of customers outside his warehouse doors begging him to buy back their widgets. With so many people selling, he dropped his prices quickly, making people even more desperate to sell before their widgets became worthless. As the prices fell further, more and more people cracked under the pressure. FOMO. Uncle Joe was now buying back an enormous volume of widgets. After several weeks, the panic selling was over, as few people had been brave enough to hold up under the pressure. Uncle Joe could now start to sell widgets again at their old levels from his warehouse full of stock. He didn't mind if it was quiet for a few months, as he had made a great deal of money very quickly. He could afford to take it easy. His overhead expenses were covered, and he could even pay his staff a nice bonus. Everyone soon forgot how and where the rumor had started, and life returned to normal. Normal, that is, until Uncle Joe started thinking one day, I wonder if we could do that again. That's a market maker. That's the story of, that's the parable of Uncle Joe. And I think that's a great illustration of market making and how market makers work. Okay. Lastly, Anna Colling states that the VPA is a subjective technique, one requiring discretionary decision making. VPA is not and never will be a technique that lends itself to automation, which is good for us. As a trader, you'll need to learn how to interpret the volume and price relationship, follow it, and incorporate it into your trading plan and daily trading activity. Warren Buffett said, the key to having more information than the key is having more information than the other guy, then analyzing it right and using it rationally. That's what VPA is all about, and that's what we're going to be studying for the next while. I want to just close with this one piece. Trading and investing is like any other pursuit. The longer you stay at it, the more technique you acquire. And anybody who thinks he knows a shortcut that will not involve sweat of the brow is sadly mistaken. So, in the coming weeks, this will probably take us a couple of months to get to. We're going to dive deep into volume price analysis. Today was just on the volume part of it. And that's it for today, guys. The resources for this is A Complete Guide to Volume Price Analysis by Anna Colling. It's one of the recommended books that we talk about. You can go to www.annacolling.com or www.quantumtrading.com or www.quantumtradingeducation.com for more information. But we'll be going over this in the coming weeks. So that is lesson 1. Thank you guys for listening and watching.